What's up, everybody? Welcome to another episode of the Stock Bros Podcast. My name is Tony. Today, we're going to talk about the Dividend Reinvestment Program, or DRIP. But before we get started, please remember to subscribe, leave a like, leave a comment. If you have any questions, let me know. And also, check out my links in the video description below. I have a link for public. If you want to get started with investing, you can buy fractional shares if your brokerage doesn't offer it. And also Acorns, one of the best investment apps for beginners that know nothing about investing. It's great. It automatically invests your money for you into high quality ETFs. And one of my favorite features is the roundup feature. Anytime you buy something, it'll invest the spare change of that purchase into a high quality ETF. And last, check out my course on Udemy for Financial Literacy and Investing 101 to help you get started with investing, teach you the basic stock market terminology, compounding interest, how investing works, stocks, bonds, mutual funds, ETFs, blue chip stocks, everything, all of that. I'll teach you about all that and everything that you need and all the tools you need to help you get started with investing. So let's get into the Dividend Reinvestment Program, or DRIP, D.R.I.P. So what is DRIP? So when a company pays a dividend, the cash payment from that dividend will automatically be used to purchase a fractional share of that same company. So you're automatically reinvesting that dividend payment back into the company or the ETF that paid you the dividend. Yes, ETFs pay dividends. Now, DRIP is an option that you can turn on in your brokerage app setting, and pretty much every brokerage has DRIP nowadays. If you don't use DRIP, then typically your dividend payment will just be sent as cash to your brokerage account. So it'll be a cash balance, or otherwise known as your buying power. So there's one huge advantage to using DRIP. And the biggest advantage is that apps that don't allow you to buy fractional shares, like say TD Ameritrade or E-Trade, they will allow you to buy fractional shares if you're enrolled in DRIP. So your dividend will be used to buy whatever fractional share amount you can buy. So say you receive a $5 dividend from Coca-Cola. With DRIP turned on, that $5 can be reinvested into Coca-Cola as a fractional share. So if Coca-Cola is $50 a share and you have $5, well, that $5 will buy you a tenth of a share. Now, if you don't have DRIP turned on, that $5 will be sent to your brokerage account and as a cash balance or as buying power, and you wouldn't be able to buy any of Coca-Cola. You would need to buy a full share, so you'd have to wait until you have $50 to buy another share. So in apps like, or brokerages like TD Ameritrade or Charles Schwab or E-Trade or and all these other brokerages where you can't buy fractional shares, turning DRIP on is a huge advantage because now you can reinvest that money back into the stock or ETF that paid you, and you don't need to buy a full share. So that's one huge advantage of turning DRIP on. If you have it off, you'll still get paid the dividend. It's just the dividend will go into your buying power, and you'll have to buy something. You'll have to buy a stock or a fund that's $5 or less, because you can't buy a fractional share. Now, there are a lot of apps that have fractional shares like Webull, Robinhood, and the one I use, Fidelity. You can buy anything with fractional shares. It works the same way whether or not your brokerage allows fractional shares or not. It's just highly beneficial for brokerages that don't allow fractional shares to turn DRIP on. Now, another big advantage is that some companies that offer DRIP may reinvest that dividend at a lower price or lower share price for shareholders that enroll into their company offered DRIP program. So you'll have to research that information on a case-by-case basis. And whether or not those companies that you're going to buy offer that type of thing. Usually you can go on the company's website to find that information. Pepsi, there are some companies I know of that do this, where if you go into their website and you buy shares directly through them, they'll reinvest the dividends at a lower price for you at a special premium. So that's something you can look into. Not all companies do that. I'm not aware of all of the companies that do, so you'd have to research that for yourself. It's not really a huge advantage. You may save a couple cents or whatnot, but maybe over the long term it'll add up. And finally, an advantage is that you're basically automating all of your investing for you. So anytime you get a dividend payment and it gets reinvested automatically instead of going in as cash, you don't have to think about it. It just automatically buys it for you. And historically, you'll have more returns in the long term with compounding interest from those reinvested dividends. Now, you could decide to leave DRIP off and you can manually reinvest those dividends into a stock or fund of your choosing, or you can just take the cash payment and transfer it to your bank account. So a dividend is considered taxable income. And if you're directly reinvesting your dividends without seeing them in your account first, you're still reported to the IRS and it's still income. So you will need to pay tax on them if you use DRIP or if you don't use DRIP. It doesn't matter. Your brokerage will provide you with all the information that you need at the end of the year to file your taxes. And it's a pretty simple process. There's no need to panic about it. They'll provide you with a form called a 1099 DIV or a 1099 DIV, which is just short for dividends. And dividend income is listed on your on form 1099 DIV as either non-qualified or qualified income. So non-qualified income or non-qualified dividends are taxed at an ordinary income rate, while qualified dividends, which are mostly dividends from US-based stocks and funds, and they get favorable tax treatment similar to long-term capital gains. And these are qualified dividends. And it's important to note that dividends from real estate or REITs, real estate investment trusts, or master limited partnerships like MLPs are not qualified dividends. No matter what, you have to pay ordinary income tax rate on REITs and MLPs. It doesn't matter how long you hold them for. So that's one downside to REITs and MLPs, but they do offer, typically they'll offer a higher dividend yield than typical stocks. So it might even out depending on what tax bracket you're in, or may be beneficial, or it may hurt you depending on what tax bracket you're in. So you can actually go and look up what tax bracket you're in and see if it's beneficial to buy REITs. Because if you're in a high tax bracket, like a 30% tax bracket, and you can go and buy an ETF like SCHD that pays you around 3% yield, and you'll get qualified dividends where you only pay a 20% dividend tax. So maybe it's beneficial to just buy the ETF that pays you a little bit less on the yield, because you may lose money in the long run because you're in a higher income tax bracket buying REITs. So that's something to think about. And if you're a dividend investor, it's always a good idea to buy these in a non-taxable retirement account or an IRA or an IRA Roth account, because then you can take advantage of all that dividend income and you don't have to pay tax on the dividend. If it's in a normal brokerage account, you're going to end up paying tax. Now, with dividends, why would you want to buy any dividend stocks or ETFs or funds in a taxable account? Well, maybe you want to use that income as supplemental income. You don't want to have to wait 5 years. You don't want to pay a penalty to withdraw it early. So I do have quite a bit of dividend income coming in on a regular brokerage account, and I do pay tax on it, but it's all mostly qualified dividends. I pay a 20% tax rate, pay a lower tax rate. And my goal is to accumulate $3,000 or $4,000 of dividends per year, and I can use that as a supplemental income to pay for a car payment, maybe a cell phone payment, and maybe a gym membership, something like that. I think of dividends as supplemental income. It's very hard to live off of dividends because you're going to have $1 million plus in capital in order to make $30,000 to $40,000 a year in dividends anyways. So it just makes sense to the average person can accumulate a couple $100,000 in capital and make a couple $1,000s in dividends. So it makes sense to think of dividends more as supplemental. So anyways, I think it's very beneficial to turn DRIP on and to use the dividend reinvestment program, take advantage of it, especially if you have a brokerage that doesn't allow fractional shares. It's a big advantage for you. So if you like the content, please remember to subscribe. It helps me out a lot, the more subscribers I can get. And as always, I appreciate the support and thanks for watching. Until next time, thank you.